You've heard the whispers. You've felt the unease. Maybe you've noticed the tension in your own neighborhood, the uncertainty in your friends' voices, the way people talk about the future with a little more caution than before. The so-called experts keep insisting the American dream of homeownership is secure, pointing to high prices as proof. They say everything is fine, that the market is strong, and that now is still a good time to buy. But beneath the surface, the foundations of the U.S. housing market are cracking. The signs are everywhere if you know where to look. Crumbling confidence, neglected homes, and a growing sense of instability. The policies meant to make housing affordable have inflated a massive bubble, one that's now quietly bursting. The cracks are spreading and the consequences are becoming impossible to ignore. Don't be fooled by sky-high listing prices. Actual sales are plummeting and inventory is piling up. Homes are sitting on the market for months and sellers are slashing prices just to get a single offer. Years of cheap money and government stimulus pushed prices far beyond what most Americans can afford. Wages haven't kept up and the dream of owning a home has slipped further out of reach for millions. Now the party's over. Homeowners who bought at the peak are facing steep losses. Many are trapped, unable to sell without taking a huge financial hit, while others are already facing foreclosure. The myth of a perpetually rising housing market is collapsing. The numbers don't lie, values are dropping, and the safety net people counted on is vanishing. For decades we were told real estate never fails. That belief led millions into dangerous debt. Generations bought into the promise only to find themselves over-leveraged and underwater. But economic reality is setting in. What was inflated by policy is now deflating fast. The correction is here, and it's moving faster than most people realize. The evidence is everywhere: rising inventory, desperate sellers, and falling demand. Open houses are empty, and price cuts are becoming the norm, not the exception. This isn't fear-mongering, it's a wake-up call. The warning signs are flashing, and ignoring them won't make them go away. We're on the edge of a downturn that could rival 2008. But this time, the problem is even more widespread. The impact will reach not just homeowners, but renters, investors, and entire communities. It's time to face reality, understand what's happening, and learn how to protect yourself. The silent crash isn't coming. It's already here, and the choices you make now will shape your future. Want the truth about housing? It's time to look past the hype and see what's really happening in neighborhoods across America. Ignore the headlines. Look at the numbers. The data tells a story that's far more alarming than most realize. Home sales have been falling for over a year. Open houses that once drew crowds now sit empty, and agents are left waiting for buyers who never show. Buyers have hit a wall of unaffordability. Soaring mortgage rates and sky-high prices have pushed the dream of homeownership out of reach for millions. New home sales collapsed 14% in May 2025 alone. Builders are halting projects and construction sites are eerily quiet. Builders are panicking, stuck with empty properties they can't move. Many are offering incentives just to get buyers in the door. Inventory is up nearly 30% from last year. There are more homes on the market now than at any point in the last decade. Homes now sit on the market for weeks, not days. Sellers are growing desperate as listings go stale and lawns grow wild. 1 in 5 sellers is slashing prices, the highest rate in a decade. Price cuts are becoming the new normal. Builders are cutting even deeper, offering steep discounts and perks just to keep cash flowing. This is a fire sale in the making. Mortgage delinquencies are spiking as more homeowners struggle to keep up with payments. For the first time, Americans are falling behind on their most important bill, the roof over their heads. The pressure is mounting. The average mortgage balance is at a record high, just as home values start to drop. Homeowners are caught in a dangerous squeeze. This toxic mix, falling sales, soaring inventory, rising delinquencies, creates a feedback loop that's hard to break. As prices fall, more homeowners go underwater, leading to more foreclosures and even more inventory. The cycle feeds on itself. Even bullish experts are now sounding the alarm. The optimism is fading as reality sets in. The data is screaming, the crash is here, the numbers don't lie, and the trend is unmistakable. The only question left is, how low will it go? No one knows where the bottom is, and fear is spreading. The warning signs couldn't be clearer. If you're watching the market, now is the time to pay attention, because the red flags are everywhere. What's driving this crisis? Three forces: interest rates, stagnant wages, and collapsing confidence. Years of near-zero rates and government stimulus fueled a housing bubble. Mortgages at 2 to 3% encouraged reckless borrowing and bidding wars. But wages didn't keep up. Home prices soared, paychecks didn't. Americans took on dangerous debt just to compete. Now confidence is collapsing. People see prices falling and are waiting on the sidelines. This fear feeds itself. Lower demand pushes prices down further. The era of cheap money is over and reality is setting in. The government built a house of cards on debt and denial. Now, the consequences are hitting American families hardest. Experts say this isn't 2008, but the core problems are hauntingly familiar, and in some ways worse. Last time it was bad loans, now it's bad prices. Homes everywhere are overvalued. Even buyers with good credit are at risk as values slide. In 2008, the bubble was in risky loans. Today, it's in the price of everything. Some analysts predict drops of 60% or more in the worst-hit areas. The government's past bailouts only set the stage for a bigger bubble. Now, with record debt and high inflation, there's little room for rescue. The most dangerous similarity? Denial. Industry insiders insist everything's fine, just like before the last crash. But housing is more unaffordable now than at the 2006 peak. The outcome, a painful, prolonged downturn that will wipe out trillions in wealth. Want to see the future? Look at the cities leading the downturn. Pandemic boomtowns like Austin and Denver are ground zero for the bust. Austin's inventory is up 69% from pre-pandemic levels. Denver's has doubled. Bidding wars have vanished, replaced by drastic price cuts. Seattle, Dallas, and even Florida are seeing inventory surge and prices fall. These aren't isolated incidents. They're a preview of what's coming nationwide. Prices became untethered from local wages. Now the market is correcting. Hard. Recent buyers in these cities are already underwater. The collapse is spreading. As confidence erodes in one city, it ripples across the country. 22 of the 50 largest metros now have more homes for sale than before the pandemic. The tide is going out everywhere, but fastest where the bubble was biggest. Don't assume your city is immune. These canary cities are showing us the way down. A housing crash isn't just about homes, it's an economic earthquake. Housing drives jobs for millions: construction, appliances, furniture, and more. As sales slow, layoffs ripple through these industries. The slowdown hits everyone from realtors to appliance makers. Banks are exposed too. As property values fall, their mortgage collateral weakens. Rising delinquencies threaten bank stability and can trigger a credit crunch. When credit dries up, the whole economy suffers. For most families, their home is their biggest asset. When values drop, people feel poorer and spend less. Consumer spending shrinks, deepening the downturn. A housing crash leads to job losses, less credit, and a collapse in confidence. It's a vicious cycle that can take years to escape. The fallout will be felt everywhere. The outlook is grim, but you're not powerless. Start by building a financial fortress. Save at least 6 months of living expenses in cash. Eliminate high-interest debt. Credit cards and personal loans are anchors in a downturn. Being debt-free gives you flexibility and resilience. Live well within your means and stabilize your income. Diversify your income streams if possible. Track your spending, cut unnecessary costs, and maximize your savings. Don't put all your wealth in your home. Diversify into stocks, gold, or other assets. True security comes from spreading your risk. Ignore the old advice to pour everything into your house. In a historic bubble, that's a recipe for disaster. Prepare now, and you'll weather the storm. Your financial future depends on it. Thinking of buying a home? Be patient. Prices are falling and will likely keep dropping. Don't let FOMO push you into a bad deal. Wait, save, and let the market bottom out. If you must buy, do so cautiously. Have a stable income and a 6-month emergency fund. Avoid low down payment loans. They leave you exposed if prices drop. Put at least 20% down to protect yourself from going underwater. Only choose a fixed-rate mortgage, never an adjustable-rate loan. Know what you can truly afford. Keep your housing costs under 25% of your take-home pay. Don't borrow just because the bank says you can. Buying a home should bring stability, not stress. In this market, caution isn't just smart, it's survival. The best deals are still ahead. Wait, prepare, and buy only when the time is truly right. The evidence is clear. The U.S. housing market is in the early stages of a historic collapse. Warning signs are everywhere, from rising foreclosures to plummeting home sales, and the data points to a downturn that could rival the worst in recent memory. The pain will spread far beyond a few cities, impacting jobs and families nationwide. As home values drop, entire communities will feel the ripple effects: lost jobs, shrinking savings, and growing uncertainty about the future. Policymakers chose short-term fixes over long-term stability, inflating a bubble that's now bursting. Years of easy money and risky lending have left the market vulnerable, and now the consequences are unavoidable. There are no easy bailouts this time. Government intervention is limited, and the safety nets that once existed are stretched thin. The only way forward is to let the market correct. It will be painful, but artificial support only delays the inevitable and makes the eventual reckoning worse. Ignore the soothing voices of those with something to lose. Look at the facts. Home values will fall, expenses will rise, the economy will struggle. The sooner we accept reality, the sooner we can adapt and recover. But this isn't a prophecy of doom, it's a call to action. Now is the time to take control of your financial destiny and prepare for the challenges ahead. Build your financial fortress, save aggressively, cut debt wherever possible, and live within your means. Every dollar saved now is a shield against uncertainty. Make smart, conservative decisions if you must buy or sell. Don't rush into risky deals or overextend yourself. Patience and caution are your best allies. Don't join the speculative mania. The days of easy profits are over, and chasing quick gains will only lead to regret. The storm is coming, but with discipline you can weather it. Prepare your household, strengthen your finances, and support your community. Prepare now, and you'll be ready for what's next. The actions you take today will determine your resilience tomorrow. Your future depends on it. Stay vigilant, stay prepared, and remember, you have the power to shape your own outcome.